Good, Millie. Thanks for reminding.
बरं मी PowerPoint शेअर करतोय ते आलं की सांगा
Yeah.
मला.
Yes, I can see it.
Okay, thanks. So let's get started. I wanted to start that timer, so let me also start that. One second. All right. So thanks everyone. Sanjay has asked me to talk about unit economics, and I'm going to touch a little bit upon startup financials because they're interrelated. With that, let me give you a quick background about myself. I'm originally from Nagpur. I'm in Nagpur today, actually, visiting family, but otherwise I stay in San Diego. And as Sanjay mentioned, I consult in the corporate finance and operations space. So that's what I do at the present. But in the past, I've had some patents in my background, some papers, had a chance to open up some innovation center and also take some ideas from concept to market adoption. So unit economics became part of something relevant to what I've done in the past, as well as stays part of what I did in my current work. So I want this session to be interactive, just quick housekeeping things. I'm in Nagpur, the connections are unreliable, and so is the electrical situation over here. So we get some outages. So if that happens, I've given Sanjay some instructions on backup approach so we can continue it seamlessly. So just keep that in mind. Second is I want the session to be interactive. So we'll go through some of these exercises together. So that way we can get the most out of it. So let's start with unit economics as a concept. Like if you have already used it with your startups, or if you think this is a subject you have come across, I would just like to understand, what do you think is the reason why we want to even discuss this topic? So can anyone give me some examples? You're welcome to just raise your hand and I can ask you to speak, or you can put your messages in the chat session and then we can read through that. So I just want to give you a quick half a minute to give me some feedback. And I'll just give you a hint. This is important from both viewpoints, whether you're thinking of it internally within your corporate environment or as an investor looking outside into your company. So any thoughts on why this was of importance? I see somebody raise their hand. Unfortunately, in this view, okay, it's difficult. I think Nilesh has raised his hand. Nilesh, go ahead.
Yeah. So Ashwin sir, I think unit economics provides that indication what is the sustainability of the business model for internal organization as well as external people.
True, true. Any other thoughts? Teja?
I think it's both profitability and sustainability.
Sure. So it's kind of a trick question, so let me just go through it. Actually, it affects pretty much all aspects of your business, and we'll go through some of it, but everything from your day-to-day management of your firm all the way to how you conceptualize your strategic intent and execute on your strategic intent. And I tried to pick out a few things that I find of interest from this topic and more relevant from a day-to-day basis. So I think, Teja, you mentioned profitability of units, so that is one area. Second is more from operations as to where and what resources are important to me and how I'm going to allocate it. So what I've done is I'm calling this an internal view. So this is within the organization, the CXOs, as well as the various teams in your organization would want to know what the unit economics is and want to use that insight to create some actionable agenda. And we'll talk about how to do that later. And then the next part is people who are looking at your firm from outside in. As you're trying to raise funds, you have your investors, they have a view of what unit economics means for you, for your firm, which may or may not be the same as what you're doing internally. So let's not go a little bit deeper. So now that we're talking about unit economics, what do you think is a unit? So I'll give a quick example. Let's take Microsoft. Microsoft has some products which we are familiar with. They have customers, which everybody is again familiar with. So again, I'm turning it back to you. What do you think would be a unit definition in this kind of a scenario? Any thoughts? Again, you can raise your hand or you can put a message in the chat box. Anyone? Okay, then let me give you again another hint. What do you think is a unit in this situation? Is it the customers? Is it the product or something else?
So I think Sushant here, I think at least in office case, it would be typically a license
Okay,
that is given.
okay, and that is very true. So I'm just going to shift over. What you mentioned is what Microsoft and others look at it in terms of their units. It is a license or subscriptions, and in this case, they mention it as subscription because for Walmart, they would have subscriptions across different products, multiple licenses. So what they care about is how profitable is a Walmart-based subscription for them. And quick caveat to that, like some people might think that, or some part of the organization within Microsoft might think of subscription as a unit, but a specific business unit associated with Office might have their own unit economics specific to that as well. So as I mentioned, it is more about the what is relevant for your organization within that, which business unit you're part of, and it could change. So now the question is, we took an example of Microsoft, and the reason I took it is most of you have firms which are either software-based deliveries or associated with software in some way. But what about physical products? Like, what do you think in that case the unit might be? So again, any quick thoughts on that? Teja, go ahead.
So it could be a product or a service. It could be a customer transaction. So depends upon the business.
True, true. And I'll just shift over, and you're very correct. Like when it is physical products, the unit is more about physical units and how much and how many of these units are going to be delivered. The reason is with my current client, which delivers medical device products, what matters is how many units of COVID testing, say, devices were produced. If 10 were produced, that is what matters. It doesn't matter how many you started with. You could have started with 20 and there could have been a fallout. Yields could have been maybe 50%. That is not what the end result, or that is not what drives your revenue. What you want to know is how many units are going to drive your revenue. So again, for startups in this cohort who have physical products, this might be a way for you to think about it. Let's go about, now that we know what is the unit, why it is important for us. The question is, how do we even calculate it? So let's take a quick look at the calculations. Again, I've taken a software as a service business as an example, just because we have quite a few software related companies associated in this cohort. So this is one way of looking at it, is you look at the lifetime value of the customer, and then you say, how much is the customer acquisition cost? And then you take a ratio. And then this ratio helps you determine how valuable that unit is for you. You, of course, want the numerator to be typically 3x or more than the denominator. So that's how you would be evaluated by your investors. That's how businesses might want to look at it and say which unit is becoming more profitable or less, and balance out your internal resource management capabilities. Let's take a look at what that means. Like, so here again, one example of how lifetime value is getting calculated for a SaaS business. Again, just a reminder that these are various ways of calculating. Again, the definition of unit might change, the calculation type and examples would change and be very specific to your business unit and your industry. We are going to take a look at another way of looking at a SaaS business in a minute, but just wanted to give you an example that there could be multiple ways. And as we alluded to it before, these units, when you're looking at their profitability, what matters is not what the exact calculation is, but how you apply that calculation over time, and how do you compare it, and what are the insights you get out of it. So whether you apply this formula or something else, you want to apply it for the window of time right now and say from now until future, what do I expect it to be? Let's say plus 1 year. Go back in the window of time, apply it, say, luckily we are in January, February right now. So look at 2023 versus 2024 forecast and then compare it. As long as using the same calculations, that gives you a directionality, a vector as to where your business is moving, and gives you a way to course control any areas that may be in trouble, or actually accelerate some areas where you think it is driving more value to your bottom line. So let's go one step ahead and take a look at another simple calculation. So in this case, I'm going to let you absorb this a bit. It's a slightly different way of looking at it. I'm going to read out everything quickly. So the average selling price, let's assume it's $100 selling price. Gross profit, let's assume after all of the costs are taken into consideration, the gross margin, it's about $80.
Sorry to
And-
interrupt. Your volume is extremely low.
Oh, sorry. I'll just lean over a little bit. Let's hope this works. Does this make any difference?
Yeah, it's better.
Okay, I'm going to lean over towards the microphone and see if that helps. So now in this situation, we are looking at the churn rate to identify how many useful life cycles you're going to get for this product. So slightly different way. And then the customer lifetime value, say 80 times whatever we had the gross profit times the number of years which we get, so 400. So here's a quick calculation for you guys to make. So what would be the customer acquisition cost? Let's say if we have, and we have annualized this. So let's say the annualized marketing expenses are $4,000, and that gives you about 34 customers for your SaaS business. So does anybody quick calculations on what the CAC should be and what the ratio should be? If you want to, I see some things in the chat, so let's see. Okay, there are some different instructions over there, but go ahead. Does anybody have any idea of what this ratio would turn out to be in this particular example? If not, I'll just share with you the.
You're around 3 or 4.
You're right. So this example, it turns out to be 3.3. And as we touched upon it earlier, anything 3x or better is considered healthy. It is worth scaling up. And this is what your external partners and investors would be looking at in your business whenever they are making any investment decisions, or trying to figure out whether one unit or one set of product or your offerings should be either enhanced, accelerated, or not. Now the question is, what is it that affects this whole calculation? I put down a few things over here. We are going to touch upon competitive landscape as one example to take a little bit deeper dive in. Now again, on this competitive landscape, want some feedback. So what do you think will happen if competition increases? How will this impact your unit economics? So rather than just giving me an answer as to whether it will go up and down, like I just want to understand, like, let's say competition increases, which of these line items do you think get impacted in what manner, and how is it going to create a final impact on your unit economics calculation or the ratio? So again, any
The
thoughts?
CAC will increase. The LTV also will reduce.
Okay, very true. So going along that thought, let me just give some more color to it. What I wanted to allude is, yes, I've picked up competitive landscape, but all these things are interrelated. So just as you mentioned, churn rate is going to increase. that means either your pricing has to change, your customer experience has to change. Some of your costs might also, not as directly, but your channel mix might change. So these are interrelated factors that you have to think about. And end of the day, when we started talking about unit economics, we said that it impacts all aspects of business. And if competitive landscape is changing and these numbers are showing you something different, you want to understand what is your customer behavior, how is it changing, and do you need to make any changes to your business strategy given some of these things coming through. So it's not that you would have not made a business strategy change if you had not calculated unit economics, but it allows you to quantify how and what changes you want to go through in your business. Because some of you might have a one product offering, but once you start having multiple products, you want to have your strategy and allocate your resources across different product lines accordingly. And this is where it becomes easy to look at it from an apples to apples standpoint. Otherwise, it becomes a very subjective conversation as to, okay, we have competitive landscape changing. Should we do XYZ? But why do you want to do XYZ? How will it impact your earnings? How will it impact your financials? And I think when Teja looks at it and talks about the finances, how does it impact your P&L? Does it impact your cash flow? How does your cash flow statement, cash flow from operations change because of what you're seeing now? So these are the questions you can start thinking about. But this unit economics example or calculation can be in the back of your mind to allow you to compare things which are different on an apples to apples basis. So now let's just take a look at startup financials. Now, till now, we're looking at unit economics from an internal standpoint, like you as the owner of the business, you as the CXO or the teams within you, and how does it matter to you? Let's take a look at it from outside in. So let's take a larger view of how startups are funded. All of you might be in different stages of this. I'm assuming you might be, this particular cohort has firms and startups that have gone through some of these stages. You have already done your research, you have already done some business planning. You might have some products either in proof of concept stage, or you might have some commercial products as well. So you might be somewhere in this zone, I'm assuming. And you're probably looking at going this path in the future, and at some point, either exiting various ways. IPO is one example, but yeah, there are other ways through a strategic partnership or other ways. But if you're going in this direction, let's take a look at the investor point of view. If somebody's putting money into your firm, what is it they're asking before they make that decision? At the very high level, they want to know if they put money in it, will they get it back and get more than what they put in? And then the second is, can they trust the people who are managing it to do their job for them and get them the multiples what they're looking for? Of course, there are going to be many other considerations, but these are the minimum questions that are going to come in there, are going to be at the top of the head. So if we do those, then how do they know that will I make money out of it? Valuations is one of the mechanisms they'll use to understand where are the numbers right now and where are the numbers going to be in the future. I don't want to touch upon the quality of team and other topics right now. They'll be covered through other sessions. But here again, the topic which we just talked about, unit economics, comes into play. How do we make sure that the investors have confidence that you as startups are going to deliver on the promise you made about whatever multiples you're going to give them? And then the next question is, if they're going to look at valuations, they're going to look at, and again, there are going to be multiple things. Valuation is one of it. But within valuation, a question comes up, what is the pre-money valuation or post-money valuation? If you haven't already come across this question, at some point, once you get at least to this stage, to the VC funding stage, that is an expected question. So I have some questions for you guys. Like, let's say there is a way to calculate pre-money. You have some Series X funding, and you can have some post-money calculations. Which of these variables over here do you think are going to remain the same and going to change? So again, any thoughts, feedbacks?
Equity value will change definitely.
Sure. So let's say that will change. Let's start from the first one. Who thinks the enterprise value will either remain the same or change? Let's just go one by one.
It will change.
So whatever is the value of enterprise, any thoughts? All right, I'll just go to the next one and say cash, debt. We are not talking about it right now. This is just the equity funding, so equity value will change as we talked about. What about the ownership, the percentage ownership, which you have in your company? What do you think happens pre-money versus post-money?
Will change.
This will change.
Will
So-
change.
So now let's go back quickly and say what happens in this example is, let's say whatever enterprise value it had, it is still staying the same. So the quick question, how do you think enterprise value is even calculated? Any thoughts?
Depending on the number of shares given to the investors at what price.
Two, three ways maybe. One is at discounted cash flow, like
True.
arriving valuation based on maybe current run rate or maybe future
True.
financial projection.
Very true. And the reason I was alluding to that is saying that whether it is pre-money, post-money valuation we are talking about, the intrinsic value of the enterprise, that does not change because that depends on your P&L. So either you're looking at your EBITDA multiples, or you're looking at your free cash flow and doing a DCF calculation on it, or any other method which you use. You're looking at comparable companies and coming out with a value. All those things depend on your way of managing a business and how much of it turns out into accounting end of the day. And that's again the next session coming up. But what I'm alluding to is this part is not going to change based on whether it is pre or post money. That is all that is going to affect your percentage ownership. And it again was a trick question. It doesn't really matter whether somebody is looking at your firm and funding based on pre-money or post-money. As long as they keep the discussion consistent, it is fine because it's just a calculation and you can go from one to another based on formulas. So, but most of you will find out that as you go into maybe Series A or even VC funding, they do want to know more from a post-money standpoint because for them, it doesn't matter what happens before. What matters to them is after they've invested in it, what is the world that they are going to look at. So think of it as what their view of the world is, where you are, and this is your view of the world. Your view of the world is going to change, but their view is more about these aspects of the calculation. So just keep it in mind. So when you have these discussions with your investors, decide how you want to provide your valuation. They're going to do it anyway in their own manner. So I just wanted to touch
There
on a
is
few
a
things.
request to increase the volume. On your device, can you increase the volume? PC or
Let me try. I'm just trying to lean in. This is I don't have a separate microphone on it, so
okay.
hopefully this is what I have right now. But we're pretty much coming to a close of our session anyway.
Yeah, go ahead. Yeah.
So, I was just going to open it up for Q&A. So let's have some questions. If you have 5 more minutes before we can turn it over to the next speaker. So any immediate questions? Yeah, Nilesh, go ahead.
Sir, while calculating lifetime value, we consider the gross profit. Now, what all components do we take? Do we also consider their, cost of sales also there, or it is just cost of goods sold? In case of, software industry, what all things actually considered there?
So gross profits are mostly through your the fixed cost you're looking at it, and it's basically your standard P&L statement, cost of goods sold, and I'm going to let actually the next session cover some of these topics for you, but I can otherwise come back to it later on. So once you go through the P&L, you'll just understand how the gross profit is calculated, and that is part of a standard P&L. So we'll touch upon this again if it doesn't get covered in the next session, the P&L portion and the gross profit margin calculation.
Hi, Ashwin. This is Sandeep here. I represent Binary Corporation.
Okay.
So my question is, typically for investors or VCs, in the order of the tabs, something like unit economics, or what is my ARR or MRR, or what's my enterprise value currently, or what's the shareholding value of all this, and probably there are more. Which are the typically top three figures which investor would see, and so it will kind of tilt their interest into the company.
So I'll say it depends on the type of investor you're looking at. So let's just take a look at a passive investor who is just putting funds into a company and expects those funds to give him some value after, say, 3 years, 5 years term. So in that case, what they're looking at is typically the first number they'll go for is your EBITDA. As how much is it? How sustainable is it? And how well are you going to be able to grow that? So that is their view of the world. So now let me give you a different view of the world. I support some of the private equity firms. So from a private equity firm, when we are looking at any company, it's not just about EBITDA. The question is, how was the EBITDA derived? Because there are various business units within that organization that are driving it. And the reason an investor like a private equity group would look at it slightly different and look at specific units and then decide is because they are going to take a look at it, not just from a passive investor standpoint, but they'll be more active. They'll be more involved in your operations. They want to know at some point which operations to shut down, which operations to accelerate, which ones they can try to integrate with all their other portfolio firms, because they are looking at it as a sum of whole where they can take some pieces out and reconstruct it. So they're looking at your company as a set of Lego blocks, but also the Lego blocks that they can use and apply towards the other Lego blocks. So that's why I said it depends on the type of investor. Like the private equity type of firms will come into play at a very later stage when you have a large volume of customers and something that they can integrate into their portfolio firms. At this early stage, where most of your firms might be VC funding and or companies coming in or institutions coming in are looking to put in funds and get some returns out of it. So EBITDA would be the number for now. Does that help?
So just for the information, Sandeep and others, we have a full session scheduled on fundraising, and this is to be given by Vaibhav Damkundwar, who's himself an investor. So you will hear directly from investors' perspective as to what they value. And Ashwin already gave you some inputs. These other sessions are meant to sort of you to be ready when an investor says, I want this, you need to have all this information ready with you. So that's how all these sessions are there, that builds up the information that is required when you get to that stage in terms of your pitching deck or investor questions and so on.
Sure, Sanjay. Thank you, Ashwin.
All right. So I think we're close to my 37-minute time.
Yeah, thank you, Ashwin. Are you going to stick around, or you have to go out? I know you're in
I'll
India.
come back again in a little bit.
Okay, great. Thanks, really appreciate.
Yeah,
I know you're traveling, and it's always hard to give a presentation from somewhere when you're traveling. Thank you.
Thank you so much.
Okay, so we'll move on to the next presentation. That's by Teja Damle. I requested her to talk. This is the first time in our sessions that we introduced a session on startup accounting, and Teja is an expert in that exact same area. She deals with startup accounting in her own career, in her own work at SOP projects, where she's accounting manager. So I'll hand it over to Teja. Please go ahead,
Thank
Teja.
you.
You can share your
Thank
slides.
you, Sanjay. So hi everybody. I'm Teja. Just a little background on me. I'm a hardcore accountant, born accountant. I'm a CMA. I've done my management accounting. I'm a CFE. I'm a certified fraud examiner. So I've been helping with some finance fraud investigations. I've been working with some firms on that. And I'm also a certified SAP finance professional. So I started my career in the US as a SAP professional, but the travel took a toll on me and I moved to accounting, pure accounting. So currently I work as a consultant for startups with a local accounting consulting firm, and I'm helping them with their accounting and reporting. Right now I'm working with 8 startups in my portfolio. Okay. And from India, I'm from Pune. Let me just share this. Is this okay?
Yeah, this is good.
Okay. So yeah, again, I cannot stress more on how important the accounting for a startup is right from day one, right from inception. I'm going to help you look at the uh, different considerations for selecting an accounting system for your business, how to set up, how to design your basic chart of accounts or cost centers, how to make use of other business softwares or other business applications, and then just a few pointers on tracking the right information in your accounting system. So yeah, uh, for uh, for for a startup, basically, the important thing that you should that takes precedence over even the cost factor is all of these things, that it helps you with the financial decision making. So accounting is, it's like you're putting in all your data, all your financial data together, coming up with meaningful reports at the end of it, and that helps a startup to take very informed financial decisions. So there are ad hoc decisions. You have a fair idea of your business, but unless you have the accounting record of your financial actions, it's difficult to come up with informed financial decisions. Again, I think Ashwin already touched base on this point of investor confidence. So investors, lenders, they often look at your financials. They often ask for all of the financial data, all of the financial analysis before they take up any investing decisions. So in my career and in my experience, I know that a startup, for this, it is a support function, so it is always put on the back burner, and people come to me. I have helped startups where they are, almost ready to pitch, and then they're starting all of this, and then we started from day one or day zero, kind of thing. So I would definitely, I really cannot stress the importance of having good financial records right from day one. Again, it also helps with the compliance. There are a lot of compliance and legal requirements that come up, and for which you need financial data. Again, not having correct financial data can lead to penalties, can lead to interest, which are again financial costs and which are completely avoidable. Tax planning and reporting, basic thing of filing income taxes. Okay, even if your business is not making any money right now, you still need to do the tax filing. And for that tax filing, for that tax planning, for a tax consultant to decide if you can claim say R&D credit or not, unless you have those accounting records, unless you are able to present clean financial data, it is not possible to come up with the right numbers for you. Financial analysis, if you are maintaining budgets, if you are maintaining the actuals to budget, budget data, all of that will be that information is vital for any improvement, any process improvement, any optimization of any operational processes. And for that, you will need the accounting to be correct. So while selecting an accounting system, I wouldn't talk about any particular accounting system here, but there are quite a few systems in the market for small businesses. Like there's Zero, there's QuickBooks Online, there's QuickBooks desktop version. And as you graduate, as your business grows, you can graduate to say Intact or go to NetSuite or move on with bigger systems too. So it will basically depend. The main consideration for selecting an accounting system will always depend upon the nature of your business. Some of the really big businesses that I'm working with, which started with zero revenue, zero employees, to now who employ about 50 employees and have invoicing customers, we still use QuickBooks Online. Because again, depending upon the nature of business, if you are into consulting business where you don't have to track inventory, or you don't have to uh, manage cost of goods sold, QuickBooks Online could be still useful for a really long time. Again, the type and volume of transactions. I have had clients who have who use on a lot of online sale transactions. So they have a lot of Stripe transactions. They have a lot of credit card transactions. So the volume of the transaction is humongous, even if the amount is small. So that's a big consideration while selecting an accounting system. Cost consideration, of course, for a startup, even $100 per month cost could be a big thing. So you have to make sure that you are doing that cost benefit analysis, where the accounting system that you select is giving you enough benefit and it's not a burden on the business in the beginning. Financial reporting, depending upon who your investors are, or if you have some bank loans, or any special reporting requirements. So depending on that, so if you are for example, I would say, if you are a not-for-profit trust, or if you are a not-for-profit organization, there are very special reporting requirements, financial reporting requirements. So make sure that the accounting system you are selecting is helping you with those financial reporting requirements. If you need any special customization for those reports. And last but not the least, the user support. Make sure you have a good account manager for your system, or you have a helpline, or you have some online support, online community, whatever. So setting up of chart of accounts, I'm not sure if how much aware you are with these accounting terms, typical accounting terms. So the chart of accounts are the different account heads under which you will be categorizing all your expenses, your revenues, to come up with your profitability figures. So make sure your chart of account is simple. I have had clients come to me who use um, a readily available template, and they end up with too many accounts. Again, that makes the system confusing, that makes the reporting confusing, because all of these accounts are active. You end up charging only a few expenses to some of these accounts, and then the income statement doesn't really look presentable. So it's important to have a structure to your chart of accounts. To say you want to bifurcate the payroll costs, make sure you have a payroll cost group under which you are tracking your monthly or bi-monthly wages. You're tracking your PTO costs, you're tracking your employer taxes, you're tracking your bonuses. So all the accruals are tracked. So you need to have a structure to the chart of accounts. Make sure you don't have any irrelevant accounts, the duplication of accounts. there has to be a logical way of presenting the income statement. Again, depending upon the nature of the business, you will have to decide if if you are a manufacturing unit, or if you are a service provider, or if you are a SaaS-based company. Depending on that, you will have a different chart of accounts for all of these businesses. And then use of cost centers, because it makes sense to track the costs. So you could have payroll costs, but you could have payroll costs for your consulting department. You could have payroll costs for your HR department. If you could have your payroll costs for your legal stuff, for your marketing people. And to track those costs at the end of the financial period, or say, or on a quarterly basis, if you design your chart of accounts along with the cost centers, it makes it very meaningful. And that's the financial data that will help you with the decision making, with your resource allocation, with your cash inflows, cash outflows, all of that. So sorry, that's what I was talking about, the reporting. So also make sure you are considering your KPIs. If your company, if your corporation has already identified some key performance indicators, make sure you're considering those when you are trying to design this chart of accounts. And again, keep reviewing these charts periodically, because as your business grows, there might be some redundant accounts, there could be some duplication of accounts, or you might need to increase the chart of accounts. You might have to build some more cost centers. So again, a periodic review of these chart of accounts is equally important. Use of other business software. So there are a lot of other softwares along with the accounting software that are available to take care of particular type of transactions. So when you use QuickBooks Online, you might want to have another software like Bill to do your vendor management, to make sure that your approvals, your payments are done on a timely basis. So make sure that application, it talks with your accounting system. Make sure it is syncing with your accounting system, so there is no duplication of work. Make decisions on, say, if you are looking at a vendor management system, you'll have to make decisions on where your vendor master data will be maintained, where the payments actually will happen, if there is any special reporting that the application is giving you. And last but not the least, the audit trail. So as your business grows, as you come up with more opportunities to attract investors, or if you're getting any acquisition, merger opportunities, there's a lot of due diligence that happens, and audit trail is really, really important when you want to finish off with, tackle all these kind of situations. Again, there could be another, some of the other examples could be, employee expense management. So I have had clients who have, say, manufacturing units outside of US, and for US, they have only the salespeople or the marketing people here. So there are tons of employee expense reimbursements that are a regular feature of the company. In that case, you might want to have a specific employee expense reimbursement software. Like there are a lot of them available, small ones, Receipt Bank, there's Expensify, which makes the record keeping really, really efficient. You have the scanned copies of the receipts, of the invoices, of the expenses that an employee incurs, and that helps with the documentation, that helps with the internal controls, defining the internal processes, and these help in standardizing your business practices and business processes for your company. Again, these are only a couple of things that I'm touch basing here. There are a lot of payroll softwares as well. You can use different payroll softwares to make sure that you are tracking your payroll costs properly, you are doing your payroll filings properly. So again, that is a very specific area to deal with. Again, tracking the right information. I hope all of you guys, if you are consulting, you have already received your 1099s from your different contracts. Or if you are employing any consultants, I hope you have already filed your 1099s for your corporations. But then tracking those W-9 forms, okay, maintaining the digital copies of them, making sure that you have the latest and the updated and integrating, making sure that your accounting system is capable of taking care of the reporting requirements at the end of the year for this. If you are into resale, make sure you are getting the resale certificates from the wholesalers or the resellers you are working with. There is an expiry date for that certificate. The reseller or the wholesaler has to renew it periodically. Make sure you have an updated certificate on your records. And if your business is expanding, especially here in the US, as you expand in different areas or different states of the US, there are a lot of different sales tax compliances that need to be taken care of. So make sure that the sales tax software you are trying to work with your current accounting system along with the sales tax software if you are into invoicing and selling to customers already. Again, these are just some of the things that you might want to consider while investing. It's not rocket science, but I often come across people that this is always postponed. This is always looked at as an extra cost. So it is not an extra cost. If you postpone it, it becomes an extra cost, because then there is a lot of cleanup to be done for presenting correct financials. So I definitely recommend that. I work with a lot of accounting, a lot of startups. I provide accounting. My husband is a CPA. He's been doing fractional controllership and fractional CFO services for quite a few startups. And again, helping with the board decks, helping with investor decks. It really matters to have good financial data and correct financial data. So yes, again, if you have any questions, anything.
Okay, if you have any questions for Teja, please go ahead and post that on chat, or you can raise your hand and ask that.
Yeah, Teja, this is Sanjay here.
Yes, okay.
So what I've seen in different startups, I have worked with a few startups, okay?
Mm-hmm.
They start with a spreadsheet to start with, right? As
Right,
far as the
right. Yeah,
financial goes, right? They start with the
right.
formula. Then they keep on slowly adding different SaaS applications, okay? For payroll, okay, they'll add one. For accounts payable, they'll
Right.
add one. For inventory management, they'll add another one, okay? So what happens is over a period of time, 3-4 years down the line, okay, there are a bunch of SaaS applications to be managed, which really becomes
Correct.
unmanageable actually. Yeah?
Correct.
So would you recommend any any system or any SaaS applications, okay, which can kind of tackle all the startup? I mean, they can do the financial accounting, okay, plus all the finance related functions, okay, for the early stage startups or
Correct.
yeah.
So Sanjay, that's why I was saying that for a really small startup, QuickBooks Online is one of the really good ones. They have as you grow, you can add payroll payroll system from QuickBooks. You can subscribe to the same. It is all integrated. As your business grows, and if you start invoicing to customers, you can add the sales tax module basic sales tax module from there. And again, as the business grows and graduates, you will have to make sure that you are updating your softwares, because
Correct.
most of these SaaS-based companies, revenue recognition is a big deal. 606 is a big requirement, and it's a different function and different accounting aspect in itself. And there are projects, I mean, consultants hired only for revenue recognition projects. So
Sure.
as it grows, it becomes necessary to add on these things. But to begin with, a software like QuickBooks or QuickBooks Online generally integrates with most of these payroll systems, most of these vendor management systems, most of these expense management systems. So it's a good starting point, I would say.
Okay, thank you.
Did we have any question here?
Are there any other questions for Teja?
Yeah, I think I have put a couple of questions in the chat window. So first is about the template for the structure of the chart of accounts. So are there any like can you help with some of the templates which can bridge the gap between what we are doing internally and how it can be projected to external world as well?
Definitely. So once you subscribe to an accounting software, sorry, Rahul, right?
Yes, yeah.
Okay. You generally get a few templates, but again, depending upon your business, it definitely needs a little bit of tweak here and there. So I would definitely suggest Rahul going to an accountant, getting these basic things set up, you know. So I have had clients who cannot afford a monthly service as well. So what I have done is I have set up the chart of accounts. I've helped them set up the cost centers. I train them to do the basic accounting, that okay, this come do it, sure all the books are in order. So it definitely makes sense to hire somebody on a part-time basis, on an hourly basis, just to get the starting point right, and then you can continue.
Can I add, Teja, to what you just said? So, Rahul,
Sure.
it also depends on couple of other aspects. One is which tax country you are going to comply with, okay? Because they may recommend some structure of accounting. For example, if you are going to be complying to US GAAP, may have a different way of looking at it, versus if you are going to comply to IAS, which is Indian Accounting Standards, may have a different template. Another point is there are definitive ways of you looking at maintaining, and I'm not suggesting you to maintain two records, but essentially your balance sheet which you are going to show to your investors could be different than the income statements and the balance sheet you are going to use for your income tax returns, for example, because it is perfectly legal. I'm not saying that you should have two books of accounts, but your balance sheet would completely look different based on the provisions you may want to exploit from a tax purpose versus what you want to show as a projection to your investors. So it depends on geographies, it depends on your purpose, and it depends on the line of business you are in. It makes no sense for you to have possibly say goods accounting heads when you are not producing anything, right? But versus somebody who's manufacturing and producing something may have a very different structure. So, I'll echo what Teja says. It is a good idea to have some professional looking at it, suggesting you some templates and taking it from there.
Right. And again, sorry, just to add to that, like you said, so when there is more than one country involved, I'm talking more regarding the US accounting here. But like he said, when you're trying to comply with more than one income tax return, or complying to more than complying also to outside of US countries, it definitely makes sense to, have that chart of accounts. So I have designed chart of, I have a client in Hungary. So we need to do the consolidations, but we have made sure that our accounting heads are same. We are using the same nomenclature. So it becomes easier for the consolidations to happen, to have the consolidated financial statements to be produced for the tax purposes, for any regulatory purposes. So I would definitely suggest taking an expert help, at least in the beginning.
And the second question is about like currently we are using Excel sheet for our projections for the revenue as well as the expenses. So that we can control or like, I mean, think about in balance between the revenue and the expenses. So is there a better way than what we are doing currently?
So right now, what I understand is you are just using the projections. Are you also tracking the actuals with your projections? Are you looking at those analytics? I mean, are you looking at tracking the difference? Are you tracking how it is changing, what you projected or what you budgeted and what the actuals are?
Right. So one is we are doing the entire, I mean, the MIS is on the monthly basis, but when it comes to the projections, we are doing for a like couple of quarters so that we, and
Correct.
again, we come to know that, if we project X, it probably there is a multiplying factor, either positive or negative. And then accordingly, we are able to track it in the Excel at present. So are there any better ways than what we are doing?
So again, using an accounting system which provides for budgets, which provides for projections is useful, because then you also get the reports from those accounting systems where you have all these deviations, where you have all this, quarter to quarter comparisons, year over year comparisons, month over month comparisons, and that helps track your financials better.
Yeah, thank you.
And again, for a basic accounting system, you can always try to go. Generally, there are some discounts happening for the startups. You generally get a discounted subscription cost for the first 3 months, 6 months. If you go through some particular bank, the banks also have some tie-ups with some, payroll providers or some accounting systems. So you get those kind of benefits too. So you might end up with really low cost subscription cost initially for an accounting system.
So Rahul, in specific in India, you may want to check with ICICI Bank. They had come out with the integrated solution for SMEs, particularly SMEs. Okay, and it could be very much helpful to you. Of course, I mean they will insist you to have a specific type of account with them, but that comes with, they had a money manager and they had some subscription. They, I think, intuitive. So there are a lot of things which they had integrated as a packaged offering for a SME type of accounts and relationship.
Yeah, great.
Okay, great. Any other quick questions before we go to breakout sessions? Okay, if not, thank you, Teja. It was very, very informative. And as a founder of startup, I also run into the same issues. I think many founders, techie founders, run into issues of accounting and so on. So I think you gave very practical suggestions. Really appreciate your inputs here.
Thank you. Thank you.
Okay, so we are going to go into breakout sessions. Viraj, can you please help on the breakout session setup? And Teja, if you can stick for next hour, if you want to stick for the next hour, you can go into any breakout session, and that it's more one-on-one discussion with the companies. You can hop from breakout room to another. And if you go into one, I would suggest those companies to prioritize their questions related to accounting and finance and so on.